Afternoon, ladies and gents. Simon Brown here doing introduction for Greg Brady's presentation. Before we go any further, if you can hear us, just raise your hand in the GoToWebinar application so that we're sure audio is being sent. Brilliant, hands coming aplenty. So Greg's presentation today, alternative international ETPs, exchange traded products. Probably a 20, maybe 30 minutes presentation from Greg. We will take questions. You can put them in the Q&A box as we go along. We'll get to them at the end of the presentation. And as always, we are recording. The video will be available on online share trading, if not later today, certainly early tomorrow morning. Greg, over to you.
Thank you, Simon, for the introduction, and hello, everyone. So this webinar is aimed, of course, mainly at Webtrader clients. And in previous webinars by Simon and Brett, they will have certainly touched on international ETFs. And this one, we're trying to show you more of the variety and concentrating more of what I call the sort of or alternative exchange traded products, of which ETFs is of course the major part. So we're going to deal with there's two, I suppose, main classifications: open-end vehicles, which is the ETFs, which most people are familiar with, and then what people are less familiar with are the closed-end funds, and investment holding companies are pretty similar in structure and nature to that. So firstly, a few comments or notes on these exchange traded vehicles. So they've grown tremendously over the last 20 years or so from when they were started. And so people are using them as instead of making individual sector or individual stock calls. But I suppose most of the growth has been at the expense of what the Americans call mutual funds, or what we would call collective investment schemes or unit trusts, because they are in many ways more convenient, they're more liquid and transparent, and in most cases the costs are lower. So you can, as I say in the next point, you can say, look, I don't want to have to, I don't want to even choose sectors, let alone individual stocks. I'm just going to buy a broad-based, low-cost. I'll buy an index in the world index, World Ordinary Stock Exchange Index, and that's great. That's a good product to buy, and it takes out a lot of hassle and thought. But I suppose everyone also needs to pay some attention to asset allocation. Should you have all your portfolio or all your assets in ordinary shares, albeit very broadly diversified. So we've attempted to map out most of the major types of products that are out there in a, as I said earlier, a very big and it's growing universe. Please bear in mind that the examples mentioned are purely illustrative, and they are not necessarily good or the best, and so we're not making a recommendation or endorsement of any of them. The examples you'll see are all US listed and denominated in US dollars. So that's with a view to minimizing Webtrader transactions cost. But of course, even applying those criteria, you can still choose plenty of options that are non-US, and that with various combinations of other geographical exposure. So the aim, as I said, is to give you an idea what is out there, but of course each individual must decide what's best for him or her. And then I've just mentioned some useful reference websites. First is ETFDB, so that's ETF database. CEF Connect, that's for filtering and looking and getting a complete list of about 600 US listed closed-end funds. And then of course Bloomberg, and then there's another blogging, investment blogging website called seekingalpha.com, also very good. So if we start with a map of the more, I suppose, conventional ETFs that one is used to. So here we've got equities, and then bonds, commodities, and then other equities. So, you know, I've shown them as a separate asset class because although they technically another subclass of equities, they do have different features, and they're best considered as a separate asset class. So that would include REITs, real estate investment trusts, and then increasingly utilities and infrastructure seen as a discrete and desirable and growing asset class for people to invest in to diversify their investment portfolios. So the classical diversified portfolio is say 60% ordinary equities and then 40% in these other kinds of assets. So the important thing is open-end funds always trade equal to underlying intrinsic NAV. So as supply and demand for the units in an open-end or an ETF changes, the managers of that fund issue more units or they redeem units, but always at the underlying value or NAV. And so, you know, even just using straight conventional index hugging, you know, and by index tracking we mean it's normally a market value weighted index, you can get good diversification, and you can build a diversified portfolio from that. So notice also under REITs, by the way, I've got property and mortgage loans. So those are that's the two major classifications for REITs. So we list a couple of examples here. So just a few comments first. So although a class of equity, as I said, like infrastructure and utilities, REITs are pass-through vehicles. So unlike the infrastructure and utilities companies, which frequently, you know, are tax-paying entities, there's no corporate tax paid in a REIT as long as they distribute a minimum of 90% of their profits, which are then, of course, taxed in the hands of the investors in the REITs. And the nice thing about these other equity or hybrid equity classes like REITs and infrastructure is that they have the more predictable income flows, and in that way they have more bond-like features, and they usually have a hard asset backing, of which an obvious example is a commercial property REIT. And then mortgage REITs essentially own mortgage-backed securities, longer dated, issued by US agencies like Fannie Mae, and these are financed by short-term debt at low rates. So when you have a steep yield curve like we've got now with low short rates and you know, and in comparison fairly high long rates, it's a great way to make money, but bear in mind these can be they're very interest rate sensitive and have a fair amount of risk because they're essentially a highly geared investment in bonds. So here, just to run through a couple of the examples. So here's this one is just pure commodities. Those are, I think, I can't remember if it's some of it physical commodities or near dated futures, but you can see it's had these are agricultural commodities. They've had a good one-year return, 9%. There's the TER is the total expense ratio, 1%, and of course there's no yield that you get from it. It's all capital gain or loss. Then we've got the iShares 20-year plus US Treasuries. As you can see, bonds generally, no matter whether they're the highest quality, you don't get higher quality than US governments. You've got a 6% negative total return for the year. So bonds, investment grade bonds, haven't been a great investment up for the year to date. Then here's utilities one I'm showing you, and then an infrastructure one from the iShares. Notice both of them similar returns, 16-17%, quite above average yields, 3 to 4%. There's quite a big overlap between utilities and infrastructure, by the way. The main difference is that the infrastructure fund in this case has more toll roads and those kind of things, as opposed to utilities, which is mainly electricity and water utilities. And then I've shown you here Vanguard US REIT, 4% yield, and the one-year total return is very similar to that yield. So that tells you that there hasn't been much of a capital gain or loss over the last year. And then you can see here's a Europe-based real estate ETF, and that's given a much higher capital growth. So Europe real estate had a very good year, and then this mortgage REIT, so that's obviously market value weighted of all the big M REITs or mortgage REITs. You can see because it's so interest rate sensitive and linked to bonds, it's actually shown a -5% for the year to date, but you can see the yield using that gearing and using the steep yield curve, giving you a very high yield of 13.4% in dollars. Now we come to the more unconventional open-end funds, or ETFs. So I think what's been previously mentioned, and you're probably familiar with, is something like the fundamentally weighted indices, where the index is weighted by things like sales or dividends. So the RAFI ETFs are good examples of that, both locally and internationally. And then you've got the more selective ones, so you're not just blindly following according to market value, but there's other selection criteria. And then what I call the hedging ones, where you can take some short positions as well as purely long. So sometimes there are, so for the ones that don't, so sometimes for these selective ones, they do still track an index, but it's often an unconventional one, and it's not, as I said, not purely market value weighted. These hedging type ETFs allow investors to assume these short positions, which often are very difficult and a big hassle especially for a smaller investor to do. And I think to bear in mind as well is that for most of the inverse ETFs, and especially I think for the VIX ETN, or exchange traded note, they're best taken for shorter term tactical reasons, and rather than take a very long term position in them, and especially if they take on extra high leverage through futures contracts. So sometimes you get, say, you may get an ultra short, in which case it gives you 2 times short exposure for every 1 times on the long side. Here's an example of some of these more unconventional ETFs. So okay, the RAFI, you can see that 1-year total return 24%, quite similar to what I mentioned down at the bottom. So your benchmark there is the SPY, which is the very huge and popular S&P 500 index tracker. So yeah, 1 year to date, the return of that has been just over 20%. So the RAFI's done a little bit better than that. Then getting down to some selection criteria, you've got the Vanguard Dividend Appreciation Index, so it chooses companies that pay regular and growing dividends, and there you've got a higher yield, but your 1-year return not as good. Then an interesting one is the Guggenheim spin-off ETF, so that invests solely in companies that have been spun out of bigger companies. So an example, I suppose, if it was a South African REIT, is when SPAR was spun out of Tiger Brands a couple of years ago, then they would immediately buy SPAR when it was had a separate listing on the stock exchange. That one's done very well over the last year, 32% total return. Another interesting one is the Guggenheim Insider Sentiment ETF. So this one chooses shares based on insiders like directors buying when they buy a lot of the shares in the company itself. Also done pretty well over the last year. Guru is a chooses shares based on the filings of the hedge. I think that the hedge funds have to do quarterly filings, and then they try and replicate most of the major holdings of the major hedge funds, and that's also given a pretty good return. Here, this IQ merger arbitrage is one of the few examples of a balanced long-short strategy, and there you see what looks like a pretty poor return, 7.7%. But bear in mind, when you've got a big short position in a very strong bull market over the last year, you're bound to underperform. And as I say in this point below here that I make, that one should also don't just look at the total return, but also consider the volatility of or the variability of the returns versus the benchmark, which for the most part is this S&P 500. Okay, then I mentioned, okay, so here's the VIX short-term futures ETN. So that's had a well, it's had a huge negative return because the implied volatility of the market has come down a lot over the last year, because the market it's inverse. Of course, the implied volatility moves inversely with the market. And then here's an example of a short position in the S&P 500, minus 20%, so pretty much equal and opposite to what we said the long in the long ETF. And then, if you recall, previously we showed the 20+ US Treasuries. Here's a short version of that, one time short position of that, and that is that's a positive return. So it was good to be short the bonds, and but it's not equal to the other one, which I think was positive, which was -6%, because it does have higher costs, as you can see, 1% expense ratio. So we come to closed-end funds and investment holding companies. So essentially, the bulk of these closed-end funds are invested in equities or convertibles, like convertible bonds and convertible prefs, and then pure fixed income or a mixture of equity and fixed income. And then hedge fund, private equity, investment holding companies that are also classed as insurance companies because they have a big reinsurance or casualty insurance component, and then more of your classic sort of investment holding companies. So the difference with the ETFs is that these ones have a limited number of shares or units, and so they trade at a discount or premium to intrinsic NAV, mostly a discount. And when you look at the various CEFs, you'll find that in fact there's pretty much examples of CEFs to match just about every kind of ETF, but in the main they are used mostly for fixed income based funds, and they often use gearing through debt. So that's the advantage of a CEF, is that you can take on debt which you wouldn't do with an ETF normally. And then investment holding companies can be thought of, I suppose, like an unregulated CEF, but remember that because they're not just a pass-through, they are subject to tax in the holding company or in the consolidated entity. So here's a few examples of closed-end funds. Try to give you a wide variety. So here's one that you can compare to the utility and infrastructure that we showed in the ETFs, the BlackRock one, a lower one-year return. So this 31% options coverage that they've used, I suppose, has capped the upside in a good rising year. Although the yield is considerably higher than in the ordinary ETF. Expense ratio, as you can see, is higher. I think the ordinary ETF was only 0.5%. This is 1.1%. So in this case, probably not worth taking the CEF to give you your infrastructure part of your portfolio. So as I mentioned below, yes, I should have mentioned it earlier, is that the CEFs not only have the flexibility to take on debt up to 30% of the assets, but also use derivative strategies, and typically that involves writing covered calls to enhance their income, and theoretically what that can do as well, if it can dampen the volatility or the sort of upside and maximum downside of your fund by using these skillfully. So this Gabelli dividend income, that's an equity one. It doesn't use any options strategy, but it does have 23% leverage. And as you can see, quite a nice NAV discount, almost 10%. Certainly that leverage has helped. That's a much higher than average yield for an equity fund, and it's given you a good, in fact above, it's beaten the benchmark. So that looks like a fairly good one. This Allianz GI equity and convertible, so that one uses some small amount of options writing, but I think it's more just equities and convertibles, and it doesn't use any debt. That's given a decent return, got a very good yield and a good discount to NAV, so that one looks promising. FAX, or the Aberdeen Asia Pacific Income, that's an example of just a pure government bond in a particular geography. In fact, most of this fund consists of Australian government bonds, and as you can see, if you're a dollar investor in government bonds, particularly Australian ones, hasn't been good because the Australian dollar has depreciated against the dollar, and bonds generally, and very highly rated bonds have actually done quite poorly over the last year, although the yield, as you can see, is quite good. And then we've got an example of one that's invested in preference shares, so that gives you a good yield, although the return hasn't been so hot over the last year. And then an example also from the same sponsor, Nuveen, of floating rate income. So they invest in underlying senior corporate credits, 30% leverage. So in theory, these, as interest rates rise in the States, you should be, better placed than if you just invest in a bond fund or purely fixed rates. But the problem is that these are linked to short-term rates or LIBOR or something like that, and they are going to stay low for at least another year. Even if longer-term interest rates are rising quicker. So again, a good yield, but hasn't been a good investment till now. So I think, I suppose the lesson is, if you are going to invest in some of these other asset classes, your timing, you have to get your timing right, particularly if you are going into closed-end funds, which usually involve a little bit more risk. And then, as I mentioned in this point below, you also get some with managed distributions. You try to keep a fixed level or fixed or growing level of distributions, and they can also distribute capital profits in addition to normal income profits. So lastly, we come to investment management or holding or private equity companies, and you'll see I haven't, for example, put a well-known classic asset manager like BlackRock, probably I think the biggest asset manager in the world, because the reason is that, you know, that's like buying Coronation on our market. There you're only buying the investment management company, and it simply earns fees from its funds under management. The difference is that these investment holding companies that I'm talking about here, you're not only buying shares in the management company, but most importantly, you're buying in the underlying funds that they run and the underlying assets that they own and manage as well. So I suppose a very rough equivalent, although you know it's not a totally perfect analogy, is that some similar SA companies would be ones like Remgro, Renet, PSG, and Brait. And if we look through some of these examples, Oak Tree Capital, hedge fund type investment company, got a nice yield. It's got a good total return. This column, by the way, is price to book. And this, as you see, my source is from Bloomberg. This price to book does look very high compared to the others, and I suppose it does bear checking what Bloomberg is quoting for that. Oak Tree Capital, by the way, is Howard Marks's investment company, and he's considered one of the investment gurus. Likewise, David Einhorn for Greenlight Capital Re, which, like Berkshire Hathaway below it, also has a big reinsurance operating subsidiary from which they source a lot of sort of, if you call it, free float funds that they can invest in other assets. So Greenlight Capital has had a good year, beaten Berkshire Hathaway, and David Einhorn is considered by many as a younger up and coming Warren Buffett. Then there's Brookfield Asset Management. We've got Blackstone, which is a classic private equity company, and as you can see, Blackstone has had a blinder of a year, 77% total return. It's just done it owned a big stake in, I think, is it Hilton Hotels, and they relisted that, did an IPO a few months ago and made a mint out of that, and plus some other ones as well. Blackstone, incidentally, as you can see, has been showing a very attractive yield. Likewise, KKR, also a classic historic private equity company, also a very good yield, and also had a good total return. Icon Enterprises is Carl Icon's investment company, also has done well. And then Leucadia is more your straight classic conglomerate, and that, as you can see, didn't have such a great year. I suppose I could have, another classic American conglomerate is General Electric, or GE, but they are, I suppose, also increasingly becoming more focused and less of your typical conglomerate. Interestingly, both Carl Icahn and David Einhorn are considered aggressive activist shareholders, and both of them over the last year or two, for example, accumulated sizable holdings in Apple, and then badgered management or the board of directors to return some of the cash mountain that Apple does to shareholders through higher dividends and especially share buybacks. And I think to some extent they did succeed because they didn't get all that they wanted out of Apple, but they have. Apple did at least partially meet what they were asking for. Okay, I think it's now over to questions, which Simon will lead.
Thanks, Greg. Ladies and gents, if you've got questions, put them in the Q&A box. A couple coming through. Greg, the first one, are these all New York Stock Exchange traded?
The vast majority, I think the vast majority are all New York Stock Exchange. There may be some that, and I think on the New York Stock Exchange, they often have a separate sort of sub-exchange called the ARCA, I think, for some of these ETFs, etc. But yeah, essentially they all there. I don't think there's any on the NASDAQ, and yeah, I think it's New York or American or the American Exchange, yeah, one of those two.
Question coming through. If you could go, you had a slide with a couple of links on it. Request if you could go back to that page. So
that yes, yeah, yeah, we can go back there. Okay.
Another question about trading them. The website Greg was referring to earlier is the Webtrader, and the URL is standardbank.com/Webtrader. I did put it in the chat at the beginning of the presentation.
Yeah, so the websites, I mean, those are really to give you more information about and help you choose, the various exchange traded products and holding companies.
A question coming through about, is this all of the ETFs? Greg, my understanding in New York alone, there's over 1,000 different ETPs listed. So this is just a slice of what's available.
Yeah, look, the maps that I did, I think that's fairly comprehensive. Look, there's probably about, I don't know, 3 or 4 sort of categories, major categories that I didn't list, that I didn't show in my maps. So, for example, you get something called business development corporations, but I didn't, and they're kind of like REITs, but I didn't put them in because I don't think buying them in the form of a REIT works well. You might rather buy one of those business development corporations yourself, one of the larger and better ones. But I think, yeah, I've covered probably, in my maps, I've covered probably 90–95% of the categories. But in terms of the actual examples, no, I mean, I've just drawn, I wouldn't say quite at random, but I mean, I've just chosen very quickly, about 30 or so out of literally tens of thousands. So, CEFs, I think in America, I saw a list of 600 ETFs listed in America alone, thousands.
Yeah. Our market was 17.
And sliced and diced by every geographic and asset class classification you can imagine.
A question coming through around the total expense ratios. You were illustrating them as you were going through the presentation. The question is, typically, would they be cheaper than total expense ratios in South Africa just due to size and competition between the market makers or product houses, rather?
Yes, that would certainly be true. Generally, they are, the US ones are cheaper if you compare. You got to compare like for like, though, obviously. And so I'm trying to go back to show you one. I wanted to show. Anyway, look, I think earlier I showed a Vanguard dividend growth one, and that has an extremely low expense ratio of 10 basis points, 0.1. Yeah, 0.1, and so there's actually quite a few like that in America. I mean, if you buy a simple ETF, broad-based, and whether it's dividends only or just there's plenty that are about 10–20 basis points, which not so easy to get in South Africa. Yeah, it's just a function of the size and the competition.
Ladies and gents, I'm not seeing any more questions coming through, so we will leave it there. My thanks very much to you all for attending this afternoon. Greg, really appreciate your time putting together the presentation and presenting it, of course. As I said, it has been recorded. We'll get it up on the standard online share trading website later today or early tomorrow morning. Thanks all. Cheers.
Thank you. Goodbye.